Welcome to today's question here, Q&A with me and Michelle.
So Joe, our question for today is, what is an HSA?
Well, that's a great question, Michelle, because an HSA can be a really powerful financial tool for people to utilize if they're eligible for it. So first off, an HSA stands for a health savings account. So here at our company, our health plans are situated in a way where health savings accounts are eligible to be used by our employees. Not every health plan may have that available, but here we do have health savings accounts. They're a great way. It allows you to put money into an account and get a tax deduction to be able to use it for medical expenses that you might have.
Makes sense. But if health savings accounts are available to me and to you, but you have a family, how does it work for both of us?
That's a great point because there are different versions of a health savings account. So you can have one that is made for individuals. You can also have one that's structured as a family. If you have a family version of the plan, you can use that for any of your family members. So I can use it for me, I can use it for my wife, I can also use it for my kids. Anybody that has medical expenses, if my plan is set up as a family, I can use it for them. It also allows a bigger contribution into my family HSA versus the individual account HSA. So really the biggest thing is who can use it as well as the amount of the contribution that you're allowed to put in every year. So family for 2024 was up to $8,300. Individual was roughly half of that you're allowed to put in and use for future medical expenses.
Okay, so now I know how it would work for me versus you, but you mentioned how contributing to it would be tax deductible. So can you show an example of that?
That's a great point. Understanding how the tax deduction part works for you is really an important part of understanding how this types of account in HSA can be so useful. So let's say that you have a medical expense that costs $100. If you were to just pay it out of pocket, you would have to pay $100 out of your pocket. It would all come from you. Let's say, though, instead you do have a health savings account, and you are first going to add $100 into your health savings account. That $100 going in will now generate a tax deduction for you. So maybe you're going to save, let's say, $25 if you are, for example, in the 25% tax bracket. You can now take this $100 out of the HSA and use it to pay that medical expense. So because you paid $100, but you saved $25 in this example with taxes, really the expense only cost you $75 at the end of the day instead of $100 because you ran it first through your health savings account.
Okay, so I definitely can see how a health savings account can potentially save me a lot of money. But let's say that I put like $1,000 in there, but I only used $900. What happens to that overage?
That's a great point. The great thing, though, about HSAs or health savings accounts are if you have an extra $100 left over in that example that you gave me, the money doesn't disappear. It just carries forward till next year. So you can still use that money. So even if you don't have, say, $8,300 in expected family medical expenses this year, you can still put all that money into a health savings account and get the tax deduction on all of it. It's not like the tax deduction only happens if you use it for medical expenses. As soon as you put that contribution into your health savings account, you're going to get that tax deduction, and that $100 can carry forward. There's another similar type of an account that your work may offer. This one is called an FSA. For these type of plans, the money will generally disappear at the end of the year. So you want to make sure you're not overfunding an FSA, but an HSA you can put the money into, it can carry forward every year, and you don't have to worry about it disappearing.
So let's say that I continue contributing to my HSA and it's built up quite a bit of funds. What can I do with those funds besides just spending on medical?
That's a great point because you can have too much money, let's say, building up into here, and you don't want it to just be sitting in a bank type of an account long term. So over time, as money builds up in here, you are allowed to also invest it. So for how our firm is set up, we have our health savings accounts or HSAs set up through a company called Lively. This is essentially the bank. There's a lot of different options out there though. Lively then can connect to our brokerage platform that we use, which in this case is Charles Schwab, and you can transfer money between Schwab and Lively within your HSA account. So the money in Lively is money that you can use for any medical expenses. You have a debit card that you can use just to pay directly for any medical expenses. But any extra money that you might have that you don't want just to sit in the Lively bank account, you can transfer over to an investment account, in this example, Schwab, where you can have it invested like an IRA or like any other account, providing more opportunity for growth going forward for that extra money that you may not be using.
So let's say I've had this account for years and it's really been building up and investing, and now it's a large amount and I'm getting ready for retirement. Can I use it for anything else or just medical?
So the answer is you do not have to only use it for medical expenses forever. At age 65 is when you are eligible to use it for any retirement-related expenses. So in many ways, an HSA can be similar to kind of an IRA with extra benefits. You get a tax deduction for money that goes into this account, just like an IRA. Contribution limits are separate from the IRA, so you can still put money into both to the full deduction amount. The second thing is that you can invest it just like an IRA if you want to. It also then can grow because it's invested like an IRA. And finally, when you reach age 65, you could also use it for any retirement-related expenses. So a little bit later than an IRA is 59 and a half before penalty. So this is a little bit later, but you still can get to a point where you can use it for retirement. And then all along the way between now and age 65, you can be using it for these medical expenses if you need to, and getting that kind of preferential treatment with using tax-deductible dollars to fund any medical expenses that you may need. So this is something that can be super helpful. So definitely check out your own medical plans and see if it's something that you may be able to utilize for you or your family going forward.
Thanks, Joe.